This is the study session on equity investments and the reading on market efficiency, which is an extremely important topic. Do you remember in the previous reading we talked about security market indexes, and in the first reading we talked about market organization and structure, and we talked about primary markets and secondary markets. And remember I said to you how important it is for the secondary markets to provide support, liquidity support, for the primary markets. In fact, I called it kind of the core of the free enterprise system. Well, market efficiency plays a tremendous role in this process. Market efficiency implies that when an investor goes to the floor of the New York Stock Exchange and pays a certain price for a share of stock, that price is going to be fair. In other words, everybody there has similar, if not identical, information sets, and therefore when they agree to trade, then that price is an equilibrium market clearing price. So market efficiency implies that markets are efficient, and the important part of this is that not only are they efficient from an operational standpoint, which is what we talked about in the first two readings, but in this reading from an informational standpoint, and that's critical. So let's get right to the first LOS. Describe market efficiency. It describes the extent to which available information is not only reflected in the market price, but also then is quickly reflected into the market price when information becomes available. I mean, let's just think about this very quickly. Remember, on the floor of the New York Stock Exchange, historically, there have been these individuals called specialists, and their job is to provide a market for a particular stock. Let's just pick Johnson & Johnson. So if you're the specialist for Johnson & Johnson, you show up for work every day with, maybe a couple 100,000 shares in your pocket, which you bought with your own money. And so you set a bid and ask price based on buyers and sellers. And remember, I said to you in a previous video that if you want, the specialist says, if you want to get in this line, you're going to buy. If you want to get in this line, then you're going to sell. And the specialist just gets the buyers and the sellers together. Well, let's suppose that the price is $100, let's say, during the course of the day, and there's an equilibrium in the market. And at 10 o'clock, Johnson & Johnson announces that it has developed a cure for male pattern baldness. 10 o'clock. And there's a commercial, and they show people like me who don't have lots of hair before we took this product. And then after a week, we've got this giant hair sticking out. So what's going to happen? Do you think the specialist is going to take his or her time changing the price? Or do you think that's going to happen instantaneously? Of course it's going to happen instantaneously. So what we rely on, this market efficiency, tells us that stock prices reflect all relevant information, and when that information changes, then that new information is reflected virtually instantaneously in prices. Now, this is not a relatively new concept. I mean, this goes back all the way to around 1900, but it lost, kind of flavor or influence, and nobody really thought about it until the 40s and the 50s. And then a guy named Eugene Fama in 1970 summarized all this stuff, and he decided to define different degrees of market efficiency. All right, so an efficient capital market is a market that reflects all available news and information. And what Eugene Fama did was he separated information into different parts. He said, let's figure out this first part, and let's suppose that there is historical information. And so prices have to reflect all of that historical information. For example, if a company paid a dividend 10 years ago, and then 5 years ago, and then 2 years ago, well, investors are going to use that historical dividend stream to predict the future dividend stream. It's also going to reflect public information. Of course, whenever the Wall Street Journal reports on some particular company, nowadays we don't even have to wait for the print to come out. We can just read it online. And then we have this small part of information called private information that is only known by the insiders of a company. Maybe the board of directors, maybe the corporate leadership team. And so I want you to think of these as, kind of three different groups of information. historical information, public information, and private information. And that'll help go a long way to explaining the degrees of market efficiency that Eugene Fama talked about back in 1970. All right, so what did I just say here? In an efficient market, new information is quickly absorbed, of course. Now, what that means is that because information is so instantaneously reflected in prices, that means that if you have some information that you think is private, by the time you get to the floor of the New York Stock Exchange, and I don't really mean physically like getting in your car and driving to New York City, but I mean logging onto your computer. Even if you're already logged onto your computer, and even if you have the trade ready to be executed with the press of a button on your computer, by the time you hit the button and we go to the speed of light to the floor of the New York Stock Exchange, that means that that information will already be reflected in the stock prices. So superior risk-adjusted returns are not achievable. And this is mostly because that there are, literally tons and tons of investors out there who are scrutinizing all this available information and trying to profit off it. Now, the one thing that Eugene Fama said, and in fact he wrote a paper on random walk among other people, is that information is not systematically released. So you can't wait like every 10 minutes, something's going to be released in 10 minutes or 5 minutes. That this news comes in a random fashion. Now, in a highly efficient market, what that means for the difference between passive and active management, it means that passive management, which maybe just means buying an index fund, does not seek superior risk-adjusted returns, and that it is preferred to active management because active management is not going to generate any of these superior returns. All right, that's an important concept. Now, we're going to talk about active management throughout the CFA program, and we're going to decide that maybe there is some room for active management and that active managers can generate some superior returns, but they're going to have to figure out a way to do it. And we'll talk about how they do that in a later time. How about the difference between market value and intrinsic value? Market value, of course, is just the price that you have to pay or the price that you get when you sell on the floor of the New York Stock Exchange or any other market. Intrinsic value, think of that word intrinsic as the core value. Core value meaning what is the fundamental value of the company. And this is the value that would be assigned to the financial security if, in fact, investors had a complete understanding of the asset's investment characteristics. Now, the implications here for markets that are efficient is that these two values are going to be the same, right? The market value ought to equal the fundamental or the intrinsic value because the market value reflects all of the fundamental and the publicly available and the relevant information regarding pricing. And so those two numbers ought to be the same. Those two values ought to be the same. However, what do we know? That it's very difficult to compute the intrinsic value of a company. Now, we do this using some simple model like the Gordon Growth model, or maybe the free cash flow to equity model. But remember, when we use a model, that model is subject to some biases and some errors, which we'll talk about later. Nevertheless, if you're smart enough to figure out what the true value, the true intrinsic value of a company is, and then you compare that to the market price. Here's a nice little graph here. If the market price is higher than the intrinsic value, well, you don't really want to buy that share of stock because when the rest of the market catches up to that relevant information, the price will fall. So we call that an overvalued or an overpriced stock. And then, of course, just the opposite happens if the market price is less than the intrinsic value. Next, LOS, explain factors that affect a market's efficiency. All right, so there are lots and lots of market participants. They are monitoring financial markets closely on a daily basis. And so if a mispricing ever exists, it's not like these people are going to look around and say, hey, do you see that there? Does everybody agree that that price is not the right price? How about if I trade on that price? No, of course. I mean, they have these program trading and executions. And remember, we talked about the ledger in a previous study session. So tons and tons of market participants, so that even if mispricings occur, they disappear instantaneously. Now, of course, the more market participants there are, the more information that is probably going to be uncovered by those market participants, which means that there's going to be a much more accurate estimate of the core value or the intrinsic value of a company. And so that contributes to market efficiency. Think of it like this way. You have a spectrum of possible information percentiles. Let's start over here and say 0. Suppose market prices reflect 0% of the fundamentals of a company, like dividends and quality of earnings and management skills, all the way over to the stock price reflects 100%. And so the more people that you have searching for this information is going to push all the way out to 100%. Now, some things that will reduce the market's efficiency is the simple fact that investors cannot unlimitedly do whatever they want on the floor of the New York Stock Exchange. You can go there and you can buy 10,000 shares of stock, but you have to have $10,000. Now, if you only have $6,000, you can use a margin account. We talked about that in a previous reading. But let's suppose that you've done all this research and you think the price is going to fall. So you go to the New York Stock Exchange and you want to say, hey, I think the price is going to fall. Let me short sell this thing. Well, there are restrictions on short selling. You have to put up a margin. You're not allowed to do this forever and ever. You have to pay dividends. And so this probably reduces market efficiency, because if everyone's betting in the same direction, if everyone is betting the long position, then what happens when prices fall? Then everybody loses. And so these limits on short selling probably reduce the level of market efficiency. All right, here's the important LOS for this reading. Contrast weak, semi-strong, and strong form efficient markets hypothesis. All right. So what Eugene Fama and others did back in the 1960s and 1970s is said, let's do this. Let's suppose that we take this historical information, past market data, and let's call that things like yesterday's stock price, and last week's stock price, and last year's stock price, and last week's trading volume, and last year's trading volume. Well, what the weak form efficient markets hypothesis version tells us is that stock prices reflect only that historical information, nothing else. So that's why it's called weak. It's not very strong. It's weak form, meaning that it has a limited information set. So the weak form version of the efficient markets hypothesis simply states that stock prices reflect historical prices and trading volume only. Now the semi-strong form is, we're getting in the weight room and we're starting to lift some weights, so we're getting a little bit stronger. So to that historical information data set, we're going to add relevant and publicly available information. So the semi-strong form version of efficient markets hypothesis tells us that stock prices reflect historical prices and trading volume plus any public information that's relevant. And these are two pieces. We know, you guys know these two pieces from a previous video. What are those two pieces? One piece is economic information like interest rates and inflation and oil prices. And the other piece is information that is unique or specific to each particular company, like earnings and dividend yields and mergers and free cash flow. All right, so you add those two information sets. So we started with a little one, right? Now we added a bigger one. And so what we say is that stock prices and stock markets are semi-strong form efficient if prices reflect historical data and public information. And now we get in the weight room, and now we're really pumping up like Arnold Schwarzenegger. We're going to call this the strong form version of the efficient markets hypothesis. And this tells us that stock prices reflect all information: historical information, publicly available information, and information that is privately held, known by the board of directors and the senior corporate leadership. So this is a really cool table to memorize each of those columns. Now we'll talk a little bit more about those as we go through some future slides, but really the basics of the contrasting of these different versions of the efficient markets hypothesis is really summarized in this simple table. All right, let's start with the weak form efficient markets hypothesis. I said this before. Security prices fully reflect all past market data, including historical price and trading volume information. And what that means is that if you're trying to see a pattern in stock prices, then that pattern is not going to repeat. Which means that technical analysis is not going to help anybody if the stock market is weak form efficient. Now let me give you a quick example. Let's suppose that we don't look at any information to form a portfolio. And all we do is look at historical prices. And we say something like, hey, we're going to buy shares of stock that experience an increase in stock price for 5 consecutive Mondays. And by Friday of each of those weeks, the price has not fallen by that price on Monday. All right, so we're just looking at this. We're trying to pick a trend. So when we find these stocks, and let's suppose we find 30 stocks that meet this pattern, and we form our portfolio by looking at just historical price information. Well, what does that mean? Are we going to be able to outperform a benchmark? Are we going to be able to generate superior risk-adjusted returns? And the answer to that question is that if the market is weak form efficient, no, we will be unable to generate superior returns. All right, so let's go ahead and ask the question, well, how do academics and professionals test whether the stock market is weak form efficient? Well, the simplest way is for us to go back to our quantitative methods discussion. And what do we know? There are things like time series data. This sounds like a time series. Stock price yesterday, stock price today. There are moving average models. We'll do that in level 2. There are ARIMA models. We'll do that in level 2. But what we're trying to do is to determine if yesterday's price or return is correlated to today's price. In other words, if you look at what's happened in the past, can you predict what's happened in the future based on some of these statistical measures? And so if there's going to be serial correlation in security returns, that implies that there is a predictable pattern. All right, so what's the ultimate here? There have been tons and tons of research. And there are some studies that show that there are serial correlations in the kind of short term. Some studies show that they're kind of in the long term. But the important point here is that if serial correlation exists, it's a violation of weak form efficiency. All right, how about semi-strong form market hypothesis? What we're doing is we're adding all relevant and publicly information to our historical price information data set. All right, so what we're saying is that prices reflect publicly available information, which means that if you trade on publicly available information, you ought not to be able to generate superior risk-adjusted returns. So let's go back to another example. Let's suppose that we decide to form a portfolio by looking at dividend yields. And we say to ourselves, we're only going to add a stock to our portfolio if the dividend yield exceeds some number, 2 or 3 or 4%. So we form a portfolio. We've got 30 or 50 of these stocks that their only commonality is this dividend yield assumption. what is going to happen to the performance of our portfolio? Are we going to be able to beat the market? Are we going to be able to outperform on a risk-adjusted base? And the answer to that question is no. That means that fundamental analysis in a semi-strong form market is not going to be able to generate superior returns. And then how about strong form market efficiency? Here's where prices reflect all publicly and all privately held information. All right, so let's think about what that means. That if we decided to form a portfolio based on private information only. Now, let's suppose that we're a fly on the wall at these corporate board meetings. And so as a fly, we can fly all around New York and Pennsylvania, where lots of corporations have their annual meetings and their board of director meetings. And let's suppose that, and Delaware, I didn't forget Delaware in there. And as a fly on the wall, we hear that this company is going to take over another company. And in another 2 or 3 days, they're going to make a takeover bid. And that takeover bid is going to be 50% greater than the current market price. All right, so all we do is we form a portfolio based on this private information only. Now, what that means is that our portfolio is simply going to generate regular returns. Are we going to be able to beat the market if the market is strong form efficient? And the answer to that question is no. Prices reflect all information. Now, when we talked about weak form efficiency, you should have said, you know what, I get that. If you use historical pricing, I get it, that you probably can't generate superior returns. If you use publicly available information, okay, I can be convinced that you can't generate superior returns because prices already reflect that information. But you should be raising an eyebrow. Can you see me up my raising an eyebrow? My dad used to do that to me when I was a young boy. You ought to think, wait a minute, if I had that if I had that private information, I'm pretty sure that I would be able to outperform. All right, so notice the final bullet point down there. Most research indicates that markets are not strong form efficient, which is the U.S. argument for the need for insider trading laws. But insider trading laws throughout the globe are different. I mean, some countries allow you to do anything. But here in the United States, we forbid, and it's illegal to trade on insider information. All right, so here's a good pyramid of a summary. Weak form efficiency reflects historical prices. Semi-strong form efficiency reflects public information. Strong form efficiency reflects private information. So remember, let's add the word prices in there. So prices reflect each of those sets of information. Now here's an even better LOS. Let's explain the implications for fundamental and technical analysis and what this means for active and passive portfolio management. So here's a great box to memorize. Look at the question in the middle there. Could abnormal returns are really just superior risk-adjusted returns. And what an abnormal return is, I mean, it's a mathematical return, but let's suppose that based on your risk, you ought to be able to generate this much return, whatever it is. An abnormal return means that you could generate this much return consistently and systematically and not by luck. All right. It just means that you're going to generate a return that is warranted by the amount of risk that you take as the portfolio manager. So I love this table here. So let's go down the left column. We've got the 3 degrees of efficiency. And then in each subsequent column, we have some kind of manner in which we can form a portfolio. So here's the question. Can we generate abnormal returns using technical analysis? And the answer is no for every version of this efficient markets hypothesis. Now, if you're a technician and if you believe in technical analysis, then you must believe that stock markets are not even weak form efficient. You must believe that stock markets do not reflect historical prices or trading volume. Because what you're doing is you are trying to develop a sense of the patterns that have occurred historically, and that those patterns are going to repeat themselves systematically. Now, how about fundamental analysis? And this is really the basis, one of the strong bases of the CFA program. We do all of this stuff as part of fundamental analysis. What are we doing? We're evaluating the core, the essence, the intrinsic value of a company based on all of the relevant variables that we discuss in these readings. So if the stock market is only weak form efficient, then it does not reflect all of that publicly available information. So fundamental analysis will work. Fundamental analysis will generate abnormal returns for a portfolio manager who uses that particular type of an analysis. But it doesn't work for strong form versions of market efficiency because prices already reflect all of that fundamental information. Insider trading then was private information. Does private information work in a weak form market? Does it work in a semi-strong? Of course it does. But it does not work in a strong form efficient market, because by the time you got on your wings as the fly in the wall and you flew to the New York Stock Exchange and you hit the button, those prices would already be reflected. And there are some proponents, by the way, of strong form efficiency. And what it relies on is the simple fact that the people who know this information are going to behave in a way to reveal that information to the public. Kind of like a tell in poker. You know, that's why when you watch the poker on television, which I don't do a lot, but these men and women, a lot of them wear sunglasses so nobody can see their eyes shifting or whatever they're doing in there. All right, how about the last part of this LOS about the active management? So what will active management be able to help us do? Active management, if the stock market is weak form efficient, will in fact be able to generate abnormal returns, but not in a semi-strong and not in a strong form version of market efficiency, because prices already reflect all of the information that we're going to actively pursue. Oh boy, let's take a deep breath after all that stuff. All right, so here's the question then. The question is, what does the academic and professional research suggest about these versions of stock market efficiency? Well, most studies agree that the market is at least weak form efficient. And most studies agree that the market is mostly semi-strong form efficient with some pockets of market inefficiencies. Only minor studies suggest that the stock market is strong form efficiency, but strong form efficient. But I want to go back to these pockets of inefficiency. These are called stock market anomalies. And what these anomalies are pockets of inefficiency that seem to repeat themselves, which means that there's some information that is not reflected in stock prices, which means that investors are ignoring important pieces of information. All right, so here's a good definition. A market anomaly occurs when changes in price cannot directly be linked to current, relevant, publicly available information. Now, let me give you a little bit of historical context. Back in the 1980s, with the introduction and the advent of technology and computerization, daily stock prices became available to professionals and academics all over the world. And so these college professors and professionals, what they did is they took this daily price information and they tried to see whether or not stock prices reflected that information, and then did it reflect publicly available changes in information, and then did it reflect private information. Well, what they found is there was a ton of these stock market anomalies that were published in academic journals in the 1980s. One careful consideration is that when you have all this data, if you're going to do some data mining or data snooping, that those anomalies might be a result of that. All right, so let's talk about some of these market anomalies. How about time series anomalies? There are calendar anomalies. How about a significant, suppose I told you that if you bought shares of stock on Monday at 2 o'clock and sold them at Wednesday at 10 o'clock, that you would always win. You would always outperform. Oh my gosh, you would think I would be nuts. But nevertheless, there are some market anomalies that show that returns are different depending on what time of week and what time of the year we're considering. Now, the most commonly referred calendar anomaly is known as the January effect, where stocks tend to outperform in the month of January. Now, this started when academics only had access to data at the end of every month. So they had December 31st data and then January 31st data, and they just compared those two over, tons and tons of years across tons and tons of companies. And they found that January had better returns. It had statistically higher returns than any other month. Whoa, that doesn't make any sense at all. But then during the introduction of all of these new computer technologies and the availability of daily prices, well, what these professors found was that the January effect was centered on just the first 5 days of January. And then some really smart people started thinking, all right, wait a minute, what's happening here? Is this really a January effect, or is it possible that many investors are selling at the end of December so that they can get that tax loss, that capital loss, to offset some of their capital gains? So they sell at the end of January and then buy in the first few days of what did I say? Yeah, they sell at the end of December and then they buy in the first few days of January. So this January effect, just know what it is, but it's probably not too prevalent. Although, we're in January now, and lots of people have been writing online and in the Wall Street Journal, hey, we're in January, expect lots of returns. And, oh boy, here's what I talked about just on that previous slide. So the January effect can be explained through tax loss selling and window dressing for portfolio managers. And there's some other examples that are behavioral in nature, which we'll talk about in just a few minutes. But focus on the window dressing of portfolio managers and the tax loss selling hypothesis. Here's another really good one. I love this. There was an article that I read when I was in graduate school that described this concept of momentum and overreaction and underreaction. And so this is what we know. When there's a release of positive information, like maybe an increase in a dividend or an increase in earnings, what happens is that stock prices go up. But the question then becomes, do they go up by the amount that they ought to go up according to their fundamentals? Or is there something else at play and that they go up a little bit more than they ought to? This is called overreaction. And this is what we know. We know that stock prices tend to overreact to bad news and underreact to good news. Nevertheless, there is a reaction to changes in publicly available information, which means that there's something else at play other than just the fundamental analysis of things like earnings or dividends or skill sets of the managers. And then let's compound that with a discussion on momentum. I heard one of the coolest things on TV the other day. One of the announcers for the football team said, "Hey, this team scored a touchdown at the end of the first half, and they have momentum." And he said, "There's no momentum like momentum." And I thought that's pretty clever. But what it means in stock markets is that, hey, if stock prices are increasing, if they're increasing and increasing, there's momentum, and investors are looking at the rising stock prices and they're saying, "Wait a minute, something must be going on that I don't know about. I'm going to jump on the bandwagon." And so investors buy shares of stock just because the price has gone up. And that further increases prices. All right, so there's no doubt. Can you get the sense of here that this overreaction and the momentum is a pocket of inefficiency? Now, there are lots of cross-sectional anomalies. And so cross-sectional means that what you do is you put together a sample of companies, right? You go out and you pick hundreds of companies and then you try to group them based on certain factors or certain variables. And clearly one of the first market anomalies that came out in the 1980s was this size effect. and that small companies tend to outperform larger companies. And so what does that mean for portfolio management? That portfolio managers ought to just buy small firms because they can always, on average, over time, outperform larger firms. Now, of course, the first reaction to this size effect was that, well, smaller firms have more risk than larger firms, and that's probably true. But when professionals and academics adjusted for the differences in size, some of this size effect remained. So there's a pocket of inefficiency. How about value? Boy, we read about this all the time, and this is going to be really important as we move through the program, especially at level 3 when we talk about styles of portfolio managers. This is what we know, that value stocks tend to outperform growth stocks. And so however you measure value, which could be a ratio like a price to earnings ratio or a price to book ratio or any other kind of a ratio, if you want to assign that group into the value category, value tends to outperform growth stocks over time. You get the sense, once again, that this is a pocket of inefficiency that violates that semi-strong form version. How about some other anomalies? The closed-end fund discount. This is really an animal that I wish I would have studied more when I was in graduate school. You know, there are just a few closed-end mutual funds anymore. I mean, almost all the mutual funds are open-ended. But the closed-end funds, they have a net asset value, right? Can you think of that as the core value or the fundamental value? And then they have a price because these closed-end funds are traded on the New York Stock Exchange or on the NASDAQ exchange. And so the net asset value and the price of the fund, they ought to be the same thing, but they're not. So closed-end funds sell at a discount. Now, why? Why is that possible? Why would you be willing to pay less for something that's worth more? I mean, of course you would buy that, and shouldn't everyone buy that and bring the price up to its net asset value? But that doesn't happen because closed-end fund discounts are persistent. And then there's this interesting concept about earnings surprises. I've read lots and lots of academic articles on earnings surprises, and you really get a whole spectrum of what's going on here. But this is what we know, is that when there is an earnings surprise, there is a tendency for prices to underreact. I said that a few slides ago. What that means is that prices then are going to just gradually rise. If we underreact, that means that instead of the price going from here to here, it only goes from here to here, which means there's room for additional price increases. And so maybe that partially explains the momentum strategies. Maybe it partially explains some other things, but notice that this once again is a pocket of inefficiency. Yeah, IPOs, this is interesting. Remember that IPOs are a fixed amount. And so it's not like when a company goes public, it's going to issue 20 billion shares. You know, there's a limited amount. And if it's a good company, then investment bankers compete for those shares. And sometimes they hold them for themselves, but they tend to give them to their better customers. I'm not sure exactly how that works. Remember, that's a violation of all the stuff we talked about back in our ethics discussion. But the important point is that there's a limited amount of those shares. And so they hit the market, and those people who weren't able to participate in that initial public offering, maybe they sit on the sidelines and they're pouting and they say, you know what, I wasn't able to get that, so I'm going to jump in and buy it before anyone else can. Now, on the other hand, the investment banking firms are always have the incentive to try to set a price that is going to clear all of those shares. And so they tend to set a lower price so that when it goes public and becomes available to public investors, that those investors will snap up those shares and the price will tend to rise. Now, some researchers have shown that equity returns relate to prior performance so that you can use things like interest rates or inflation or maybe dividend yields. But there's not enough evidence in there for that to be considered to be an anomaly. Whoops, sorry, I went ahead there. But here's how I want to summarize this section, because we're going on to behavioral finance here. I want to summarize this, that if you're faced with a question that says something like, hey, you can use this particular strategy to generate a superior return, well, then it has to be a violation of some form of market efficiency. Because if the stock markets are strong form efficient, then there's nothing that an active portfolio manager can do to generate superior returns. They can only generate returns that are consistent with the level of risk that he or she is taking. Now, whether that risk is defined by standard deviation or beta or some other measure, that's a different story. All right, how about describing behavioral finance? This is really a cool topic for me, and I think it's fascinating. Let's go back to Harry Markowitz and Modigliani and Miller and Eugene Fama and William Sharpe, these founding fathers of finance. Traditional finance theory is based on this notion of a rational investor. All right, so what does a rational investor do? A rational investor quickly and completely and accurately processes all publicly available information. And then when new information becomes available, they do the same thing, but they instantaneously process that new information, and they all arrive at the same decision. That's a rational investor. But back with the advent of these anomalies, and during the 1990s, there were a few professors who started merging the link from the psychology field with behavioral economics and how it relates to what goes on the floor of the New York Stock Exchange. We call that behavioral finance. And behavioral finance proponents believe that there is no such animal as a rational investor. Meaning, think about the pressure of having to perfectly and completely and accurately process all of this information. Oh my gosh, I have a headache just thinking about it. Behavioral finance proponents think that investors are just normal. There's a normal investor out there. And this normal investor processes this information, but maybe not quickly, maybe not completely, and maybe not even accurately. What's known is that this normal behavior takes shortcuts. And this normal investor suffers from cognitive errors, brain malfunctioning, and emotional biases, suffering of the heart and the soul, that may lead to irrational decision making. And so this is going to be an underreaction or an overreaction to new information. And so behavioral finance goes a long way to explaining those pockets of inefficiency that we just talked about in those previous slides. Now, the rational investor is risk averse. That's that whole Harry Markowitz efficient frontier. What were we told? That in order to get an investor to take this much more risk, you're going to have to offer that investor this much more return, or whatever it is. And remember that Harry Markowitz, it was not linear, so the slope was not constant. But then remember the fascinating thing. We added a risk-free return there over on the horizontal axis, and we drew the capital market line. It was linear. That slope was constant. Well, behavioral finance suggests that these normal investors are not really worried about Harry Markowitz and that trade-off. They are not risk-averse, but they are loss-averse. People have a tendency to dislike losses more than they like comparable gains. And the example that I use, especially now that we're in the NFL playoffs, I love giving this example about Tom Brady. Tom Brady, quarterback for the Patriots, he's won 1 million games in his life and he's won a bunch of Super Bowls. And somebody asked him the question, what's your first Super Bowl memory? And he said, losing the last Super Bowl. So he's Super Bowl MVP, he's got MVP, he's got all these records, and what does he remember? So that loss was more painful to him than those other wins. And there's no doubt that this is not rational. This is just normal behavioral human qualities. And of course, this is likely to explain underreaction and overreaction. So if we're loss averse, what does that mean? That means that, let's suppose that we bought a share of stock for $100. And what does that tell us? We tell everybody, hey, we bought this share for $100. Look at me. I did all this fundamental analysis. I'm a great analyst. $100. This stock price is going to shoot up. But for some reason, the stock price falls, and it falls to, let's say, $90 a share. And it stays $90 a share for months and months. And the fundamentals of the company has changed, and we were wrong about our investment, whenever that was a year ago, to pay $100. So what are we thinking? We're thinking, all right, I could sell now at $90 and signal to the market that I am a loser. You know, my daughter has done that to me many times over her lifetime. Nobody wants to signal that they're a loser. So this loss aversion bias then suggests that investors will tend to hold on to losing stocks, even though they know the fundamentals have changed. So what does that mean? That means that stock prices, if we're not selling, stock prices are going to not fall as much as they should have fallen, right? If we're all holding on to losers, then that stock price is going to be artificially higher. All right, loss aversion. Remember that investors, normal investors, behavioral finance investors, are loss averse. Oh, overconfidence. There's no doubt about this. I remember when I was in graduate school, I read a study in which some finance professors asked the CEOs of tons and tons of Fortune 500 companies. And they said, what we want you to do is we want you to rank yourself, rank your skill set, rank your performance based on all of the other CEOs that you know. And guess what the average was? The average was like 92 or 95%. So each of these executives ranked themselves in the 92nd or 95th percentile. What does that mean? That means that these executives look around and they say, oh, I'm better than that dude over there. I'm better than that woman over there. I'm just better than 95% of the people. So what does this mean for portfolio managers and for financial analysts? What we're tempted to do is overestimate our ability to accurately determine that intrinsic value, which means when we're assigning an overvalue or an undervalue target to a particular company, we're probably going to be wrong because we think we're smarter than everybody else. Now, one of the fascinating results of all this is that this mispricing, this overconfidence bias tends to occur more in higher growth companies, because it has been shown that higher growth companies have stock prices that tends to react more slowly to new information. Now, think about the flip side of that. This has a lot of explanatory power going back in suggesting that value stocks outperform growth stocks. So think about it. If we're overconfident and we're all buying these growth stocks and we're bidding up the price of these growth stocks to a point well beyond its intrinsic value, what has to happen over here to these value stocks? These value stocks, just by virtue of the overconfidence bias in the inflated price of growth stocks, means that they're probably going to outperform. Of course they're going to outperform. Oh, how about information cascades? Well, we talked about this just a little bit. So we have a transmission of information from those who first have the information, and that influences the decision of others. And this has a lot to do with momentum. It has a lot to do with serial correlation. But here's the example that I like to give you. You guys know I give sports references and I like to give movie references. One of my favorite movies of all time is this Trading Places movie. And I won't go into the details, but remember, Duke and Duke Securities, what they were trying to do is corner the orange juice futures contract market. And so they started taking the long position at the beginning of trading in the orange juice futures contract. And the other traders around them, they saw what the Duke and Duke brothers were doing. And there's a scene in the movie where they say, oh, look at the Duke and Duke, what they're doing. Let's hurry up and follow them. Information cascades. And that leads directly into the herding bias. And there's no doubt that everyone likes to be popular. And so portfolio managers, they tend to buy the same stocks that other portfolio managers are buying, so that when they get together at the end of the day, they can say, oh yes, did you see I bought that stock? And they'll all say, yeah, we all bought that stock. High five, wasn't that awesome? All right, so this was a great reading for me, at least, because we started with efficient markets hypothesis and we asked the question, all right, are markets efficient? And we worked through a bunch of stuff, weak form and semi-strong and strong form. And we said, all right, we can live with this traditional finance theory. But what happens when it stands up to all the tests? We like the theory. It makes perfect sense. But suppose that investors are just human. They are not perfect machines in processing this information. They take shortcuts. They have cognitive mistakes. They have emotional biases. Of course, investors are going to make mistakes. So think about those anomalies as pockets of inefficiency.